Thanks for tuning in to this week's investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, we're going to start this week as we have been doing with our chart of the week, in which we title it Tariffs Not Impacting Fundamentals, at least of Yet. So, looking at the Q2 earnings season, it's getting closer to coming to a close here. Um, Over 400 companies have reported, and what we can see of the companies that have reported, that gray bar there is at the S&P 500 index level. Earnings have grown over 10% in Q2, which is a very healthy number. And it's done so on about 6% sales growth, which is also a healthy sales number, but that implies that margins have actually expanded, which isn't necessarily what you would expect, giving something of a slowing economy and the tariff input price pressures. However, when we look at the details of this, we see that the real strength has come from communication services and information technology. Both sectors have grown earnings much faster than the index itself. And those are really the sectors that have seen margins expand. Some of the other sectors that are more impacted by either a slowing economic backdrop or tariffs, such as energy, materials, goods producing things like the staples sector, those areas have seen less earnings growth and a little bit more margin pressure. So far, it's really been that artificial intelligence theme that's showing through in the corporate fundamentals. But regardless, fundamentals on the S&P 500 index itself have been solid, at least in the Q2 earnings season. And along with that, that kind of supports the strong returns that we've seen. This is the year-to-date returns for some major asset classes. And we can see that the S&P 500 has now returned about 9.5% this year. Small caps have really lagged. And the thing I would point out there is small caps do tend to be more economically sensitive. So a slowing economic backdrop has not been a good environment for small cap stocks. Now, international markets have really continued their leadership. Developed international markets up 21.2% this year, and emerging markets up 19% this year. So that has been a strong trend that we've been talking about really for these last 7 or 8 months. Now, when we look at the economic data last week, we got the Global Purchasing Managers Index update. And so what that does is it combines the service sector and the manufacturing sector, and it's based off of surveys in which they ask these purchasing managers how business is going and what the outlook for business is. And they also ask them questions around prices. And we can see here in the bottom clip of this chart, the orange bars are the 3-month change in that global purchasing managers index. And we can see the last bar on the right. You see a pretty strong performance from the global PMIs, up 1.6 points over the last 3 months. That's pretty solid after we saw PMIs contract for about 6 straight months there. And historically, when the PMIs are in expansion territory, when they've been improving over a 3-month period, the market has done well. So this is consistent with what we've seen this year. Now, inflation pressures, that's something that is also covered in the survey data. And we can see here that there is a big dichotomy between global ex-US inflation pressures and US inflation pressures. So the blue line is global ex-US, and you can see that inflation pressures have been pretty benign from a perspective, whereas they've really come up from a US perspective. And that's likely the differential in what tariffs are doing in terms of the impact to the different regions. And that's been supportive of global central bank interest rate cuts, even though the US Fed has not cut interest rates yet. And we can see that here on this chart here is showing the percentage of global central banks that have decreased their interest rate lately. That's the orange line in the middle, or decreased their interest rate as the last move that they made at all. And you can see that 91% of global central banks, their last move was an interest rate cut. And historically, when global central banks are coordinated in their easing cycles, the markets have performed well. So this has been another thing that has helped with market returns this year. And the US Fed is like along with the other central banks here in a soon to be rate cut. So if you look at the rate probabilities for this September 17th meeting, there's about an 87% chance right now that the Fed's going to cut interest rates by 25 basis points at that meeting. Now, some of that is due to the new appointment to the nomination to the Fed that President Trump made, and some of that is due to weakening labor market data. But nevertheless, we have seen the probabilities for a rate cut in September go up. Now, when we look at the fundamental picture, this chart really does a good job of showing what the change in price has been on the S&P 500 and what the change in earnings has been on the S&P 500. And you can see that markets aren't crazy. They tend the movement in the market does tend to track the movement in expected earnings. What you can also see is that market prices have likely outstripped earnings a little bit too much here. And that is what's caused kind of a relatively rich valuation environment for stocks. It's not very overdone, but valuations are fairly rich, and that's something to be cognizant of. And it's especially something to be cognizant of because the long-term trend is potentially stretched for the market as well. So what we're showing on this chart in the top line is just the S&P 500 price index. So this doesn't include dividends. And then we show the trend line, the long-term trend line, and we can see that through history, the S&P 500 price has appreciated 6.8% per annum, and now we're quite a bit above that long-term trend line. Actually, the S&P 500 is 68% higher than that trend line if we had just gone 6.8% per year. And historically, that has tended to lead to some pretty subpar returns for stocks. But the big caveat I would give is on a total return basis, so inclusive of dividends, the market is not nearly as stretched. So that's what we're showing here. The blue line is the S&P 500 total return. So that's the price and dividends reinvested. Now the trend line for that is 10.8% per annum, and the market's only about 13% above that trend line. So when we think about return to shareholders, that would imply that the market is not overly overdone. Still maybe a little bit pricey, a little bit ahead of itself, but not the dire situation that some would have you believe. And so what's going on here? Why is there a big difference between the price index only being very overbought and the total return index being basically on its trend line? Well, it comes down to the composition of how returns are happening lately. So what this chart does is it breaks down by decade. So the far left bar is the 1920s, then the 1930s, 40s, 50s, and so on. And it shows how those returns were made in each decade. The blue dot is the the orange dot is the annualized returns. And we also show how much of that is attributed to the earnings growth in blue, the change in price to earnings ratios in black, the dividend yield in red, and then a little bit of a combined effect that the data couldn't really map everything out in green. And you can see here that from 2019 to 2024 here so far, this 5-year stretch, you can see that the dividend yield is lower than it was in prior decades, but earnings growth is pretty robust compared to some other decades. And a lot of that can be attributed to corporate buybacks. So companies are returning cash to shareholders by buying back their own stock rather than paying a dividend. And the way that manifests itself is in better earnings growth and higher market prices. You're getting more of your return because market prices are going up, not from the dividend. So the change in structure and how managers are treating their cash and the cash return to shareholders has a lot to do with that discrepancy that I showed on the prior two charts. So we'll wrap things up this week with our chart of the week here. Fundamentals have held up, particularly for the tech and communication sectors. So it's mainly been driven by AI investment trends. Tariffs have likely been more impactful to the goods producing sectors. So that's something to be cognizant of. Now, last week we did see a strong week, good returns, and international stocks continued to lead the way here this year. And that's been a big theme that we've talked about all throughout the year so far. Now, global economic growth has improved in the last few months, and inflation pressures are benign globally, and that's supportive of this broad-based central bank interest rate cuts. Now, the picture for the US is a little bit more complicated. There's a little bit more inflation pressure here for the domestic economy, and that's kind of kept the Fed on hold, but the Fed is now likely to cut in September. Now, the market is stretched from a valuation perspective and also relative to its long-term price trend. But when we consider that corporate buybacks have become a bigger source of those shareholder returns, the market does not look quite as overbought. So that's what we have for you today. As always, thanks for joining us and have a great week ahead.